Greetings to everyone. For Independence Day, I'm going to do some straight talking today for the good of the country. The bond market is broken. Earlier this week, even a small state loan auction struggled to find buyers because banks simply don't want to buy. They're sitting on losses. The 10-year G-Sec yield is at 6.5%, up nearly 35 basis points from, the early June levels. It went to 6.17. It's almost as if there has been a rate hike. The first cause of the bearishness is the feeling that the rate cut cycle has ended. The stance has changed. A second reason is the fear that tax collections are going to be seriously disappointing, and hence there may be fiscal slippage, maybe more bond issuance by the government in the second half. To discuss the plight of the fisc and the plight of the bond markets, I have with me Suyash Chaudhary, the head of fixed income at Bandhan AMC, and Aditi Nayar, the chief economist at ICRA, an expert on the fisc. So Aditi and Suyash, thank you very much for joining me, and my greetings for Independence Day. But let me start with you, Suyash, because the bond market is in such a state. What do you think is dragged the bond markets into such a sulk?
So Lata, we think there are two aspects at play. One is that the bond market has taken time to figure out the revised approach of monetary policy. So as you know, monetary policy this year has been very focused on ensuring transmission right away in the most broad-based manner possible. And for that reason, they have upfronted rate cut and liquidity injection. So for the first phase of this period, the bond market's expectations were almost over-delivered by the central bank. And then in order to signal to the market and economic agents generally that monetary policy should not be relied upon as the only game in town, the stance was changed in the June policy, and subsequently the tone of policy has been interpreted as being slightly hawkish. So there has been a bit of an expectation shock to the bond market from perceiving a central bank who was very focused on monetary easing to suddenly a change of stance and communication. Yeah. So in some manner, you can say that the expectation channel of the bond market for the time being has been neutralized. So that is one aspect leading to a belief that, the next move, whenever can potentially be a hike, although our sense is that we are still in the middle of the slowdown cycle, both globally and locally. And any sort of a rate hike is actually miles away. In fact, you cannot even rule out further rate cuts from the central bank. So this is first piece. Second is that, as we know and is well established, duration supply from central government bonds has gone up substantially over the last couple of years. In the first phase, there was pension and insurance demand to absorb this excess duration, but in this phase, that demand has been lacking. And yet the supply calendar has not, at least till date, been tweaked. There is one additional development. For whatever reason, this financial year, the average duration supplied by states also has picked up meaningfully. Oh. So now you're seeing, a market which is somewhat scratching its head with respect to future direction of monetary policy, at the same time being called upon to take on duration supply that it clearly does not want. So the need of the hour is probably a bit more, dynamic reassessment of how much duration can be supplied to the market and in what form.
Got it. Just a word for our viewers. When Suyash says duration supply, he means longer term bonds. Perhaps state governments and central government should be borrowing more 10-year and below or 15-year and below, and not 40-year as they have been doing. That's the ask of the bond market, as Suyash puts it. But Aditi, let's look at the fisc. I mean, we discussed enough about the rate cuts and rate cycle. We'll come to that if time permitting. But is the fisc going to face a situation where it may have to issue more bonds or the fiscal deficit be higher? Because the tax collections, corporate and income tax, although, the first returns we will know only in August, the date has been extended, but still it is abysmal. Tax collections are flat year on year, and there is an expectation that a package should be given to the exporters who are suffering. So is it a real fear that the fiscal deficit may be higher?
Thanks, Lata. So let me start with a couple of factors that are giving the fisc some amount of buffer this year, and then I'll go into how we are assessing the tax collections. So first of all, we talked a little bit about this earlier this week on the nominal GDP side. I'm going to start with that. That's the denominator. We're going to assume that Government of India is going to try and keep its fiscal deficit at 4.4% of GDP, which is what the budget estimate for this year was. So the nominal GDP itself for last year ended up being higher than what had been penciled into the budget. So that's for FY25. For FY26, we're all now working with nominal GDP growth that's probably going to be just about 8 to 8.5%. But even with such a moderate nominal GDP growth, the nominal GDP denominator of base for FY26 will still be a little bit higher than what the budget for FY26 had penciled in. So a tiny amount of buffer coming in from that, about 15 to 20,000 crore is what we're assuming is the leeway that we have. Secondly, on the non-tax collections, particularly the RBI dividend, that's giving us some more buffer as well. So 50,000 crore, I would say, between the nominal GDP, RBI dividend, and the fact that at least right now, the disinvestment situation is looking much better than what it typically does at this point in time. So at least we're not looking at a slippage the way that we're usually a little worried that there might be a bit of a slippage from disinvestment. I would say today we're sitting on a better position than that. So 50,000 crore is a buffer to either absorb lower tax revenues or to increase expenditure or a combination.
Foreign taxes much lower than expected.
So Lata, I would reserve my assessment of how bad the situation is at least until we see the September quarter or data. The first quarter tends to be the smallest quarter for tax collections normally. And here if there is a base effect, then the numbers look quite awry very easily. It doesn't take a lot for the numbers to look very strange. There do seem to be a lot of refunds. And of course, the filing deadline is also extended this year. So I do think we'll be in a much better position to actually assess the tax situation by the middle of September. And I'll tell you what view I'll be looking for. Whether we get a double tranche of tax devolution to the states in September or not. If we do, then I think we should assume that things are okay. If we don't, maybe that will be the first signal that we should be looking at tax collections being weak.
You know, as it is, the income tax assumption in the budget was about 15% or so, and last year we fell short as of March 31st by a bit. So the lower base makes the tax expectation or assumption even higher, which is, I'm finding it difficult to believe that we will be able to reach that kind of taxes, in which case the buffer will be absorbed. Suyash, is there a genuine fear of even higher issuance, or is the bond market now only worried about the combination? That is, we don't want more longer term paper, please sell more short term paper. Is that the only worry, or is more issuance itself a worry?
I think the dominant effect is confusion with respect to the future of monetary policy as well as the higher duration. And bear in mind, duration is not just the long end, but even, for example, the 15-year segment is starting to show the pressure. So the need of the hour is really to hike, issuances in the 5-year odd segment where, balance sheets will be more in a position to buy given very low funding rates today. I think, nobody seriously expects any very proactive expansion in the fiscal deficit as a response to a slowdown. Some expansion owing to a shortfall because of nominal growth slowing is, well par for the course, and I think the bond market will accept that. It needn't even translate into more dated GSEC borrowing. It could very well be funded by some amount of treasury or other sources if required. So I won't say, that is a fear that is as yet a big portion of the bond market sell-off.
So let me squeeze in the other problem which I think the bond market is facing, the quality of buyers and sellers. Last year we had good buying by the insurance companies and we had that bond inclusion. So the FPIs were buying. Those two are absent now, and banks are also absent because, there has been a change of rules on how you account for HTM, held to maturity. So do you think three buyers are absent now? FPIs are absent, insurance is not buying much, bankers are not buying much.
Absolutely. In fact, sometimes we joke that it will be a better thing if part of the government borrowing could be done as corporate loans from banks, because, everyone is wanting to do more loans. Pricing there is much more aggressive, and yet mark-to-market risk, as you suggest, appetite for that has diminished substantially. There are ways around. It's just that transmission was from the bond market also needs to be on the radar of the central bank, because clearly this massive widening in term spreads without a fiscal stress in sight is something that is at least impeding transmission via the bond financing market, and it should be part of what central bank watches, we hope.
I agree with you, and let's see. Insurance companies have also clearly let down the bond market. Aditi, can there be a reigniting of hope of a rate cut? If not for inflation reasons, because the RBI keeps looking at 12 months forward and saying that it is a 4%, you may squabble whether it is 4.9 or 4.5, but either way it is above their comfort zone. But can there be a growth reason to cut rates?
So, as of now, we think the growth reason to cut rates will take quite a bit of time to really manifest. When we spoke earlier this week, we discussed our views on the GDP growth for Q1. We're penciling in a 6.7% GDP expansion in Q1, and we feel that that's going to be the highest quarterly print for this fiscal year, because a lot of the growth impulses have been upfronted in a sense. We've had very high capex from the center and the states. We've had upfronting of exports to some geographies as well. So these drivers of growth are likely to taper off as the year continues. But you will end up with growth prints that are possibly going to be sub 6% by Q3 or Q4. And even the high frequency indicators may only start showing that stress much later in the year. So inflation uptrend is going to give you bad optics for a rate cut, and the growth optics for a rate cut will also be quite back-ended. My baseline expectation is that we're now in an extended pause scenario. I'm not sure we can count on a rate cut.
Okay. Yeah, by the time you get to know that the third quarter GDP is, sub 6 or maybe just about 6%, it is going to be February. So will we get a December rate cut is a bit of a question mark. February perhaps we can expect. Suyash, to wind down the conversation, what is your ask? If you have to ask the governor something or the finance minister something, what does the bond market want?
So first is to restore the expectation channel for transmission. See, nobody is really asking for meaningful further rate cuts. It's just that, the slowing economic cycle, both globally and locally, still has some room to run. Whereas, commentary almost suggests that this is the end, or at least that's how the bond market has interpreted it.
Yes.
The first task is to, basically try and restore the expectation channel that we are still in the middle of a particular phase of the economic cycle. And, that obviously will have support from the central bank. To be fair to them, they have been hinting in that direction, but probably the bond market wants a little more clarity. Second is a bit more, active duration management of supply, or, the tenure of bonds that are supplied to the marketplace, given that India doesn't really run any meaningful refinancing risk. Most of what is borrowed locally. We are running a current account deficit which is 1% of GDP.
Or even less.
So, we don't really have any meaningful refinancing risk. We are a solid macroeconomic story where hopefully structurally bond yields will be lower. And therefore, even, some bit of interest cost saving can happen for the government if duration management of supply is done a little more proactively basis demand from the market.
Got it. Thank you very much for putting it so succinctly, Aditi and Suyash. Have a great year ahead, and let's hope this Independence Day, we will be rewarded in the days and weeks to come with some more clement policy for the bond markets. Thanks so much for joining us. Time for a break. Chartbusters up next.